Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Chris Stadele of the live Squawk Commodity Corner, a fantastic newsletter that deep dives into commodities. Today, we're going to be having almost like just an open conversation about everything we've seen recently. So we're going to touch on a number of elements, probably talk about the impact of tariffs as well. So this isn't an interview per se, be more of an open-ended conversation about everything that we can think about commodities. That being said, Chris, welcome to the show.
Thank you. It's great to be here, Rob.
Really looking forward to this. And let's start with what's been going on in the last few weeks. So we've seen, obviously, everyone's talking about tariffs and so forth. And if we're sticking that onto the commodity side, there were, as we were just discussing off air, some or most elements, most metals, etc., haven't been tariffed, but there are a few things that have been, and you want to touch on that first.
Yeah, absolutely. Like you said, Trump did not tariff any metals in his Liberation Day tariffs a couple of weeks ago. But I do want to clarify that just a few hours before that, he did put a 25% tariff on canned beer imports as well as aluminum cans. And then also, the new 25% tariff on foreign cars and car parts. Who knows if there's going to be exemptions coming down the pike? Who knows? And likewise, there was already the 25% tariff on aluminum and steel in place even before these announcements occurred. And I'll just kind of dive right into my feelings if that's okay with you, Rob. I was apprehensive about commodity prices even before these trade wars and tariffs started. And now the trade wars have solidified those thoughts. And like I said, there were no new metals tariffed in the Liberation Day announcements, but there's likely going to be a lot of demand destruction. So I firmly believe that these tariffs are inflationary in the short term, i.e., the spot market, but could be deflationary in the long term. And I'll give you a real world example that I just saw yesterday. There's an Ace Hardware store just north of me that sells barbecue grills. And right on the sign, right by the highway, it said, and I wrote this down so I could directly quote it. Tariffs start smoking grills on May 1st. So I love that quote. I wish I could have came up with that myself. But in a nutshell, that just shows that, hey, these tariffs are going to have real world applications and influences. And the thing is nobody knows, if tariffs are going to, or excuse me, if consumers are going to buy on these rising prices. Now, to be fair, I don't know how much, his grill prices are going to be, but it wouldn't surprise me in the least if they go up by X% if people are just going to forego buying a grill this summer. And you can see this type of mentality, being played in every darn market that you can think of. And that's exactly happening already in most metals markets. We saw a pretty good bounce in aluminum and copper and a handful of others, and now we're starting to see that flush out. Um, and what's interesting to me, forgive me if I'm, uh, uh, speaking right off the top of my head here, but there was a lot of metals that were already at serious or historical inflection points right as these tariffs were being announced. And I'll give you an example. Aluminum was sitting roughly at $2,700 a ton. And that is normally when China really starts uh, ramping up their exports, so long as the arbitrage is advantageous versus their domestic prices. And China is the OPEC or what China is for the aluminum market is what OPEC is for the aluminum or for the oil market. You
Mhm.
cannot talk about one without talking about the other. If we see a decent flush out, to the lower end, 2100 ish, that might be where they could step in and start buying, but who the heck knows? Obviously we know that their economy is not doing that great, so I would not be a betting man that they're going to be, buying in droves for to say the least. And, as we know, copper was essentially at the same inflection point too. That was
Mhm.
rated about $5 when all of these tariffs started, and they had a good flush out to roughly $4. They barely held on to the $4 level with this recent sell-off, and now they're trying to find a medium ground. So, and you'll probably never guess what commodity or what metal I'm actually quasi bullish on, if you want to take a guess.
All right, let me take a guess on what you are quasi bullish on. I want to say I'm just going to think off the top of my head randomly. I'm going to say rhodium.
Okay. Rhodium does not have a futures market, so
Okay,
I only
on the
really
futures market. Okay.
okay.
Okay. Second guess on the futures market. He's going to be. I don't want to say platinum or palladium because yeah, I know your recent newsletter looked at the PGMs, so I'm not going to say them. Oh no, Chris, you stumped me. I'm not able to. I'm not able to think on what are you bullish on at the moment and why?
Okay. It's actually a Cobalt, which is a relatively new market to the CME. They only started trading a handful of years ago, and even prior to what's been going on recently, well, let me just kind of give you the recent news. So, back in February, the DRC, the Democratic Republic of the Congo, which is responsible for about 70% of global production. They actually put out an export ban because there's a global supply glut, and we're sitting at multi-year lows. So that's exactly why they did this recent export ban to hopefully try and boost up prices, which the futures responded immediately. They rallied about 80% in a couple of weeks, and we've pulled back a little bit since then, but I'm still optimistic on Cobalt, quite simply because, again, there's only really one major supplier, and they were going through, sadly, they've been going through an Mpox, formerly known as monkeypox, epidemic for the past several years. And I was always leery that they were going to have a pandemic style shutdown like like we had 5 years or so ago. That never materialized, but that's always in the back of my mind. That they could start clamping down on production or having something similar to what we experienced here. So um, that's the only real one that I quasi bullish on. So, and in relation to other metals that are directly related to the automotive market, steel prices, they did almost exactly what aluminum did. Steel is kind of a weird, wonky, really thinly traded market. Those have collapsed really bad in the past few weeks. I think it's solely because of the tariffs. So like you mentioned about platinum and palladium, those platinum, roughly 40% of platinum end usage comes from the automotive sector. And if I remember correct, it's about 75% for palladium. So, so long as these tariffs, on foreign car imports are in place, I don't really foresee anything dramatic happening in the platinum and palladium market. So, same thing with nickel. I just did a piece on nickel. I'm going to be doing another piece on that in the weekly as well. Most nickel is used for stainless steel production. So if you're a Tesla owner or buyer or investor, that should be a concern to you because the new Cybertrucks, are all made out of stainless steel. So nickel, I'm not bullish on. They actually broke into a 4-year low just in the past few weeks. But again, so long as these automotive tariffs are in place, I just can't get too darn bullish on any of those. So, um, And in relation, sorry if I'm kind of ping ponging here, but I just want to make a couple quick points on
Mhm.
why it was extremely strategic to not tariff any metals in the Liberation Day tariffs, from a few weeks ago. I'm just going to give some figures here on our net import. I'm from the States, by the way. I'm from based out of Chicago, and I just want to give a couple, or well, several data points on our import reliance on various metals. So for nickel, it's 48%. For zinc, it's 73%. For cobalt, it's 76. For platinum, it's 85%. For copper, it's 45%. For aluminum, it's 47%. For steel, it's 13%. Lithium, I'm not a big student of the lithium market, and I can give reasons why in a moment if you'd like. That's well over 50%. And rare earths, people have been talking about that so much frequently, recently. We're at 80% in relation to rare earths, but that's kind of a deceiving number because we mine a lot of rare earths here, but they all get processed in China. So, China's new export ban could really shake up prices in the rare earths market. And the problem is, just like I said a moment ago, I really only cover markets that have futures that are,
Mhm.
easy to digest and follow the data and the prices on. Who knows? It's going to be the Wild West in relation to rare earths, you know. So,
Okay, Chris, I think there's a lot to unpack there. Thank you for going through all of them. I just wanted to every now and then I like to go into layman's terms because I never like to assume that everyone knows everything about everything. So going back to Cobalt there. Now, if I'm right in saying the reason that you might be bullish on that, apart from what you just explained there, is it's also isn't it primarily used in like lithium ion batteries? So has it got quite a role to play in the future of like electric vehicles and things moving forward? Why the extra bullishness on cobalt? What is cobalt used for, basically?
yeah, that's essentially the only end usage for cobalt is lithium ion batteries. For mainly for cars, and there's a few other applications, but like I said, and I should have made this point a little bit clearer, from the get-go. Whenever you see uh, essentially a monopoly in production when I said
Mhm.
that, the DRC is responsible for about 70% of global production. I always get a little apprehensive when I see numbers like that because any minor hiccup, just like what they're going through right now, could have dramatic effects on prices. So, that's exactly why we went into a supply glut, and that's exactly why they're trying to work out of that supply glut right now. So, um,
I think that's a very valid point because I know that in the last few weeks, I've had a bit of spare time. I've been responding to people on Substack. You get all these people, people with questions like, what's the latest stock you bought and all that sort of stuff. And I said that the latest one, or one of the latest ones I bought was Sibanye Stillwater down in South Africa. And
mhm,
people were asking, well, why would you do that? So, well, number one, when rhodium explodes, as in the price, then watch out because it will go absolutely catastrophically, you know, parabolic high. It is doing it a disservice. But I said,
mhm,
apart from that, yes, South Africa obviously got a lot of problems at the moment, socio-politically, etc., etc. But I said, if you look at Sibanye Stillwater, sort of, they had a bit of selling, I think, in February. So, in my opinion, it was buying it, at a low point. But it wasn't just rhodium, it wasn't just PGMs. It was also looking at their assets around the world, and they've got their fingers in pies in terms of gold and silver in different jurisdictions. So that was part of my thesis.
mhm.
That being said, yeah, PGMs. You mentioned about platinum and palladium, and I know you wrote about that on your newsletter from the week just gone. A lot of usage for those two in catalytic converters, but obviously with not just tariffs, but the perception and the way that people want the markets to change, i.e., we've got to be greener, we've got to have electric vehicles, etc. How do you think that could potentially affect PGMs moving forward?
Sure, sure. Obviously that's a very, very long-term forecast. And the problem is with some of these futures markets, and especially related to precious metals like gold, silver, platinum, palladium, they're essentially only traded in the front month. So it's very hard, whether you're trying to buy or sell, it's very hard to hedge, 6 months, 8 months, a year out. Going forward, I think there is going to be a lot of demand for those, but I'm always leery. When you only look at the demand side, you also have to
Mhm.
look at the supply side. The reason that I haven't really studied or done too much in relation to lithium in any of my write-ups is because you can pull up a chart and see that those have been flat for a long, long, long time. They produce lithium on every continent on planet Earth except for Antarctica. So
Mhm.
I think the supply for lithium is always going to be there, unless by some miracle of God, all lithium production shuts down worldwide. So
Mhm.
um, and if I may, and I have no uh, uh, opinions on any specific equities like the one that you just mentioned, but since this is the Contrarian Capitalist podcast, and you mentioned gold, I just do want to briefly touch on gold,
Mhm.
and I definitely have a contrarian viewpoint about this because obviously I've been stumped on gold. I'm very willing to admit where I've been right and wrong and all that type of thing. But after kind of diving into the data, and I'm going to write about this week in the weekly post that'll come out
Mhm.
a day early because of the holiday. Large speculators have actually been strong sellers on gold ever since we've gone above 3,000, and the futures data from the CFTC proves that. While Main Street has become aggressive buyers via ETFs, and that in and of itself, makes me quite nervous. So,
Mhm.
am I going to say that gold prices are going to crash? Absolutely not. I'm just very leery, on the market structure, as it were, right now. So, um, as for platinum and palladium, again, I'm not looking for any significant quote unquote crash in those. I'm just leery that we could tread water for quite a long time in those markets, so long as these tariffs and the perceived demand destruction are in place. So, as you can tell from the outset, as the old saying goes, buy low and sell high. I
Mhm.
do not, other than Cobalt, maybe, I cannot foresee or I do not have any buy low, sell high type of scenarios playing out, at least in the short term. I mean, who knows? Obviously, we've known the volatility that's gone into all markets, especially the stock market, the past few weeks. Trading from tweet to tweet is brutally hard, nearly impossible. So, maybe these tariffs will be old news by, Memorial Day here in the States. Who knows? But my guess is that we're going to be discussing these for a long, long time. And, who knows what kind of volatility we're going to see. So, um, I'm not a financial advisor, so I cannot say, do this at X price or whatever. But if I would give any recommendations, I would just say uh, try and keep it non-marginable, like with options, or just make sure that you have stops in place or some type of mental, hey, I'm only going to risk $1,000 or something
Mhm.
like that. So, I think that's the safest way to play these darn markets nowadays. So.
Yeah, there's a lot of chaos out there at the moment. I know last week I was recording an episode with Dr. Naomi Prinz, and we were talking about the Fed and talking about, who's going to potentially blink first, whether it's going to be Trump or Jay Powell. And in the time of recording, and we both said, anything can happen at any given time. Don't be surprised. And that was when it was last Wednesday. So that was when the official pause or 90-day pause on a lot of the tariffs were put on. So I think I'd come off the call, had a look at the markets, and Dow's up by nearly 3,000 points. I was like, whoa, that's that's pretty extreme. I know there's going to be a lot of people listening to this that will say, Rob, yeah, great. You need to talk about silver again. So I'll ask you, Chris, what are your thoughts or what notes do you have on silver at the moment?
Sure. Obviously silver and gold trade pretty much in tandem. So I do not have a silver chart pulled up right in front of me, but um, if I'm quasi bearish or cautious on gold, then I have to be quasi bearish and cautious on silver as well. So the nice thing about silver, though, is that does have the industrial applications that gold really doesn't have.
Mhm.
So, I think that will always kind of be a put under the market. But, again, that's such a spec-driven market that, it's really hard to say that, um, silver should stop at X level, So, and also too, I always like to point this out, in relation to, the physical market of specifically of gold, and you can make that equation in silver too. For gold, we trade more gold in one day than what's ever been mined in human history. So, trying to, really make a lot of, uh, wherewithal or hoopla, I should say, about the physical market really doesn't hold a lot of water with me. So, um, and actually, your point about comments from Jay Powell and and also obviously Donald Trump, it sounds like Jay Powell is just gonna let this kind of play out, and see how the chips fall. One interesting thing, in relation to interest rates and bonds and all of that. I was actually bullish on bonds for quite a while. I thought bonds would be kind of not necessarily the buy of the century, but just, I think they'd hold in quite well and they would be a pretty decent, inflation hedge. And just ever since the Liberation Day tariffs, all of that has kind of gone out the window to a certain degree, just because of what's been going on underneath the market in relation to some of these basis trades and all that kind of stuff. And one thing that I am a very alarmed about and very scared about. I had a friend that said that he's actually going to be shorting some shorter term notes, not longer term bonds, quite simply because he was questioning the full faith and credit of the U.S. government. And never in my lifetime would I've ever thought anybody would ever say that to me, So I'm
Mm-mm.
very alarmed at that. And again, that just shows, uh, the volatility and all of the questions that we have, not only in relation to the U.S. economy but in the global economy. When you start seeing moves in traditional assets like our bonds and notes that almost don't happen unless you're looking at like emerging markets or junk bonds or something like that. Man, there's a lot of craziness happening out there. So I hope that
Yeah,
I
yeah.
answered your question correctly or to your satisfaction. Again, I'm a little leery on practically every metal except for cobalt.
And I think with reason as well, Chris, and that was one of the reasons for having you on and to have a chat about this because I know that, and I should say actually when I was talking about the aforementioned company earlier on, yeah, very good point. We're not financial advisors, so please don't take anything of what we say as any financial recommendation or financial advice. I know that I always like to say that when we're faced with times like we are now, when there's a lot of uncertainty out there, not just in the USA but worldwide, I always like to say to people that you should always look and do your homework about physical gold and physical silver. Now, whether you go out and buy it is up to you. Again, this isn't a financial recommendation, but if you look at the history of gold, if you look at the history of silver, if you look at what's happened before and what we're going through now, it's history's not exactly going to repeat word for word, but there's some major themes that play out in on the lines of currency debasement, inflation, and what that does to various prices and values of things. So yeah, I always like to, I just want to put that in there again and say that if you're yet to take a position in physical gold or physical silver, it's not a financial recommendation. I highly recommend you go and read, the Live Squawk commodity newsletter as well. Listen to the various podcasts I've done on gold and silver, and you make your own decisions. That disclaimer aside, we've spoken about gold, we've touched on silver. Obviously, everything you're not overly, don't have much of a bullish sentiment on, apart from cobalt. Anything else? Any other elements? Any other metals that you would like to have a look at or talk about, Chris?
Sure. In relation to your statement about, being a buyer of, some physical commodity like gold or silver and putting it, in your vault or underneath your bed or something like that. I have no problems or qualms with anybody doing that, but do not take out your life savings and do that. So if you've got a portfolio where you try and maintain the like a 60/40, stocks versus bonds, and now you want to throw in some precious metals, do it at 5 or 10%, or something like that, whether it's physical or ETFs. Again, do not, go out and do something wild that, you cannot easily back out of. So, and to your point about currencies, I actually jotted this down, and I actually did uh, discuss some wild currencies in last week's newsletter that probably many people don't really ever think about. And this again just goes to show the craziness in the markets that we're seeing, uh, across the board. Uh, the U.S. dollar index has absolutely collapsed, in recent weeks, and that is a basket of various currencies, and most of which, or the largest percentage, is versus the euro. So obviously the euro has skyrocketed recently. But what's interesting, and I'm going to mention two currencies that are not part of that basket, the Brazilian real, and then you actually just mentioned South Africa a few minutes ago. Their currency is absolutely collapsed recently. I believe it's at either all-time lows or very, very close to all-time lows. Quite simply because of these automotive tariffs.
Mhm.
That's essentially the only real thing that I can nail down in relation to the South African rand. In relation to the Brazilian real, that what's kind of interesting, that is falling. That is, at an all-time low or near an all-time low, similar to the rand. But that's actually been positive for a few commodities like um, corn and soybeans. So, it's interesting that not all of these relationships work perfectly like you think they would. So, and that's really, in a former life, I was an ag commodity broker for about 9 years. So I still really follow those markets. We'll keep this one mainly to metals, but I just want to briefly touch on grains too, if I can.
Mhm.
We're in the midst of, putting our crops in the ground here in the States. Things might be, slightly below, the average pace that you like to see, but it's still early, and farmers, they can get that crop in the ground fast. So, that is the only quasi-bullish thing that I can see in relation to grain markets, is that just the Brazilian real has been falling, and that really doesn't make me feel comfortable. You know what I mean? So,
Mhm.
I don't foresee that to be a long-term thing. And again, uh, it's going to be crazy in relation to these tariffs. So again, nothing is chipped in stone so long as tariffs are the name of the game. So,
Yes, there's a lot of a lot of things I think that are gonna or could potentially happen moving forward. Like, I know that you have also written quite extensively or had a lot of thoughts about oil. So let's go and talk about that because it's not just OPEC, and you actually touched on the episode I done last week with Doomberg where we looked a bit more into natural gas and oil. But if there's a big if there's some form of recession and so forth, the chances are that oil price could go a lot lower. But then
mhm.
again, as part of a commodity super cycle for the next 5 or 10 years, it could go a lot higher. That's just, I mean, they're just my thoughts. What do you think? What are you seeing in the current oil markets as we stand?
Sure, sure. Doomberg is a friend of mine, so I'm obviously going to boost his thoughts and his analysis and all of that. But to be fair, I'm not quite as bearish as he is. I know he was at one point in the podcast from a week or so ago, was talking south of $50. I'm a little bit more bullish in that regard. Um, the U.S. has really stepped up to the plate in the past 10 to 15 years in relation to oil production, not just in Texas in traditional oil fields, but I've been in the Bakken in Northwest um, North Dakota, and that's just really coming into the fold in the past 10 to 15 years, and that's a shale place, so they're going to have oil and natural gas. The right now, at one point, I remember when their break-even price for new wells up there was like $40-ish. Now it's about $60-ish. I think, and that's basically the base case for most of the United States. It obviously depends on what play or what field you're in Texas, New Mexico, Oklahoma, North Dakota, wherever.
Mhm.
But some, right around that 59 to $61 is the low end of break evens for most oil producers here in the States. So I think that will add, or excuse me, that will be a put underneath the market to a certain degree. Now, just as we saw this past week, we can easily get down into the 55-ish level, perhaps even low 50s. But I do not think that's going to be, hypothetically, if we do that again, let's just say if the economy really does, deteriorate, I think that $50 level is going to be, kind of a new inflection point because obviously again, since we're the global swing producer now, no American producer wants to run in the red for very long. So, I think, we will start to see shut-ins if or shut-ins and or wells not being drilled. If we do start to see, that oil price stay at 55 to $50 for X amount of weeks, so and OPEC, they're extremely brilliant. They know exactly how to, maneuver, dial, how to maneuver the dials in relation to oil production. If prices get too low, they'll tamp back down, et cetera, et cetera. So, I think there's enough to keep the market buoyed from being, 30-ish or 40-ish, if that makes sense. So.
Thanks for sharing. It's always good to get as many different opinions, and that's the joy of doing this podcast. To be perfectly honest with you, Chris. So oil covered, gold and silver covered, cobalt covered, PGMs we've looked at a bit of agriculture as well, uh, aluminium or aluminum and steel. Is there anything else on your radar at the moment, either on a supply or demand side? Anything that you think might have gone under the radar that people need to know about in the markets, regards to metals?
No, there's really nothing off the top of my head that's alarming. I think we covered, quite a bit, and we're pretty efficient about it. So, if there is, I'm very happy to do another podcast. We can do another deep dive into that. So, but no, I think we've covered, pretty much everything that I think is, you know, uh, at the top of everybody's minds right now. So,
No, perfect. Well, I agree. As I always like to ask the question. Um, anyway, well, in that case, Chris, I think that's been really informative. There's a lot of great analysis, great information there. And again, as we said multiple times, we're not like independent financial advisors, so don't take anything we say as investment advice. Please do not make any decisions based on what we've spoken about today. I always like to end by giving people the opportunity to find out how you could be found. So how can people connect with you? How can people get hold of that newsletter? How do people get in touch, Chris?
sure. So we are on Substack. We just started on Substack earlier this year. All of my daily posts are free. And then the weekly newsletter that we've discussed, that is $34.99 a month, or it's $3.49 for the year. So, and all of the weekly newsletters, those come out on Friday mornings US time, and those are all brand new articles. So it's not like a recap of or a repeat of a free daily post that I did, the
Mhm.
Tuesday before or something like that. So
Perfect. Well, I will, as usual, I will make all the notes on Substack. And if you're happy to be watching this on YouTube, just go to that description box and all the links will be in there. Chris, thank you for your time today. I think I learned a lot from that, and I think it's a lot for people to think about moving forward. So thank you very much for your time and look forward to round two later on in the year.
sounds great. Thank you, Rob.